Hello, everyone, and welcome to The Buck Stops Here. I am Catherine Murray. Well, I wanted to provide you today with perspectives on the Canadian economy, the Canadian markets, income opportunities, and also the global markets, and a couple of stock ideas. A lot certainly to get through, and we certainly need someone with a lot of experience to have that discussion. Joining us today is Kevin McSweeney. He is Senior Vice President, Portfolio Manager, Head of Global Infrastructure, Lead Canadian Equities at CI Global Asset Management. Kevin, great to be with you. And with a title like that, I did have to read it, and it's earned and deserved after 23 years in the business. So thank you for joining us. And I should also mention CI manages $123 billion in assets under management.
Nice to see you, Catherine. Thanks. We'll shorten it up next time, I promise.
Okay, no, it's an achievement. So, let me first get your take on the Canadian economy because things really do feel like they have slowed down. We've certainly seen the impact of higher interest rates on mortgage payments and consumer spending, inflation affecting that, higher taxes, higher gas prices. So, what's your view right now on the Canadian economy?
It's tough out there, to be honest. I mean, you saw the negative 1.1% GDP print last week. You've seen some of the consumer spending measures come in reasonably soft. Frankly, when you just go back into where the economy is and where the flow of funds is happening, from wages to interest payments to, corporate investment, there's a lot of weakness out there. The principal driver of that simply is that we have a very leveraged consumer with a very high sensitivity to interest rates. And the increase in interest rates related to inflation has taken, I think, as of the last measure, about 54 or 56 billion dollars out of Canadians' pockets directly, and that just can't that's going to have an effect. That's going to leave a mark, and we're seeing it across the economy.
And where do you think we are, Kevin, in terms of seeing the effect and the impact of that? Because there is always a time lag in terms of the impact and how long it takes for people to go through their savings. And then now we're in this new reality.
I think it's probably fourth inning or so. There's an ability to abbreviate the game if the bank does turn on its interest rate, if the Bank of Canada turns on its interest rate policy. But as of right now, if all you do is you go into the StatsCan or the OSFI data and you say, well, okay, we've currently had about a third of our mortgages that are variable. We've had a number of mortgages, from 2018 have been resetting all through 2023, about 200, 300 basis points or 2 or 3% higher. That's what we know has happened. If all I do is I extrapolate, well, what happens if all of the fixed rate mortgages from 2020 and 2021 that were set at, let's call it 2%, get refinanced in 2024, 25, 26 at 6%? That is dragging our interest cost into, interest expense into kind of 5%, 6% of GDP, that from about 3.2% right now. That is all of the Canadian growth that we generally have. And it has a whole lot of knock-on impact. So we still have yet to see that big renewal wave, but even the small amount of fixed mortgages that have refied and the variable rates have already taken a big bite out of the Canadian economy. It can't continue to go like that.
Well, why can't it? I mean, if the BOC and the Bank of Canada held steady this week at 5%, if they continue to hold steady and don't lower rates, what happens?
You're choking off everything other than people's mortgage interest payments, frankly. You're choking off the ability of the Canadian capital markets to receive savings. Savers will be fine, but savers and the people who are most highly leveraged and who are the highest, have the highest propensity to consume, will stop saving, and they will stop putting it into the equity markets because they don't have enough money left over after inflationary or mortgage interest inflationary episodes in basic goods or in mortgage interest costs. They just won't have enough left for, say, Canadian Tire or Kids Presents, or, as we enter the holiday season. Any aspect of the Canadian economy that's discretionary is simply going to be squeezed out. And you'll see all of that kind of play. You'll certainly see that play out if things don't change on the interest rate front.
And what's been interesting is when you listen to the Bank of Canada, they have an issue with the federal government spending, and
Yep.
the Bank of Canada is trying to catch up with the spending. We're going to pick that up on the other side of the break. We'll be right back.